Welcome back to Build Wealth Now News, everyone. I'm Billy Bob, and today we're doing a deep dive into one of the most polarizing yet widely followed stocks on the market, Palantir Technologies, ticker PLTR. It's trading around $135 right now, down from its 52-week high of over $207. And investors are asking the exact right question. Is this still a buy, a hold, or should you take some chips off the table? Joining me is our lead market analyst, Sarah. Sarah, before we get into charts and price targets, we always start with the foundation. Walk our viewers through what Palantir actually does and how it makes money.
Thanks, Billy Bob. Palantir builds and deploys enterprise software platforms that transform massive, disconnected data sets into actionable intelligence. They operate 4 core platforms. Gotham, used heavily by defense and intelligence agencies for mission-critical operations. Foundry, which helps commercial companies build what they call an ontology, basically a digital twin of their entire business logic and data. Apollo, which handles continuous secure software delivery across any cloud. And their newest flagship, AIP, or Artificial Intelligence Platform, which securely connects large language models to enterprise data so companies can actually deploy AI agents in production. Revenue comes through a subscription model, cloud-hosted SaaS, on-premises term licenses, plus professional services for implementation. Their go-to-market is a classic land and expand strategy. They bring clients in through AIP boot camps, embed the ontology into daily workflows, and then watch contract values scale as more departments and use cases get added. It's a high retention, high expansion model.
Sticky, scalable, and clearly AI adjacent. Now, in our research framework, we always classify a company into one of 6 growth phases before we even look at valuation. Where does Palantir sit today?
Based on their Q1 2026 10Q filing, Palantir is firmly in phase 3, rapid growth. Our decision tree checks 3 things: capital returns, operating income sign, and revenue growth. They actually paused their $1 billion buyback program earlier this year, so we move past that. Operating income, strongly positive and accelerating. Q1 GAAP operating income hit $754 million. Revenue growth, $1.63 billion in Q1, up 85% year over year. That's well above the 20% threshold. So we're not looking at a cash-burning startup or a mature utility. This is a company that has successfully crossed into profitable scale while still growing explosively. That's rare.
Phase 3 means the business is executing. But execution only matters if it's defensible. What's the moat look like? Is this just AI hype, or is there real durability?
The data points to a wide and widening moat. The primary source is switching costs. Once a company or government agency builds its ontology in Palantir, it becomes the central nervous system for data, workflows, and decision-making. Ripping it out is operationally risky and financially painful. Second, intangible assets, classified U.S. government contracts requiring top-tier security clearances, proprietary architecture, and deep AI governance expertise. Third, counter-positioning. Very few firms can serve both highly classified defense operations and Fortune 500 commercial enterprises at scale. Network effects are moderate today, but AIP is starting to create internal data network effects as more AI agents feed back into customer workflows. Overall, the moat isn't just wide, it's actively expanding as AI transitions from experimentation to mission-critical deployment.
So the foundation is elite. What's actually driving the growth forward? I know we map this using a specific matrix.
Right. When we run Palantir's growth drivers across new versus existing customers, 3 stand out as exceptionally strong. First, product expansion, specifically AIP. The bootcamp model is rapidly converting new commercial logos while simultaneously upselling existing Foundry and Gotham customers into paid AI workflows. Second, use case expansion. They're moving into healthcare, manufacturing, supply chain optimization, and allied foreign governments, which opens entirely new verticals. Third, their Salesforce/channel scaling. Those boot camps are essentially a highly efficient, repeatable customer acquisition engine that's compressing traditional enterprise sales cycles. Geographic expansion and partnerships are moderate, but the core engine, AIP, driving both new logos and deep existing account expansion, is firing on all cylinders.
And how does that translate into the actual financial health metrics? I know Phase 3 companies have very specific thresholds we track.
This is where Palantir shines. We track 6 key metrics for Phase 3 firms, and PLTR is scoring green across the board. Revenue growth plus 85% YOY, threshold greater than 20%. Gross margin, 87% GAAP, threshold greater than 60%. Operating margin trend expanding to 46% GAAP/60% adjusted. Cash flow from operations over revenue, 55%, threshold greater than 15%. Net dollar retention, 139%, threshold greater than 120%. Customer count growth plus 34% YOY to 954 customers. Every single metric signals a company scaling profitably, not just burning cash to chase top-line growth. They're generating serious cash while reinvesting for expansion.
That's textbook execution. Now let's address the elephant in the room, valuation. If the business is this strong, why are investors so split on the stock price? Let's break down the numbers, specifically the analyst consensus versus the discounted cash flow or DCF model.
Valuation is where reality meets expectations. Let's start with the analyst consensus. The Zacks research report dropped today with a consensus price target of $158, implying about 17% upside from the current $135.26. Across 29 major analysts, the consensus clusters between $174 and $184, with a wild dispersion from $60 to $255. That dispersion tells us this stock is highly sensitive to execution and macro sentiment. Notably, 100% of analysts who revised their Q1 through FY2 estimates over the last 60 days moved them upward. Forward earnings are projected to grow nearly 99% year over year, and projected sales growth is sitting at 71.8%. Now compare that to the discounted cash flow model from Simply Wall Street. Their DCF fair value estimate is $149.06, suggesting the stock is currently trading about 9% below intrinsic value. That's a modest discount. Here's the tension. On a relative basis, PLTR trades at a forward PE around 90 times, while the software industry average sits near 18 times. The DCF assumes a conservative, normalized long-term cash flow trajectory, which is why it lands lower than the street's consensus. Wall Street is pricing in sustained AIP-driven growth acceleration, margin expansion, and AI monetization durability that a standard DCF model tends to smooth out.
So the DCF says it's roughly fairly valued to slightly undervalued around $149, while analysts see $158 to $184 based on continued hypergrowth. That's a classic premium growth dynamic. But what does that actually mean for our viewers right now? Should they buy, sell, hold, or do nothing?
I'll give you a clear, risk-aware framework based on the data. For long-term growth investors, 3 to 5+ year horizon. This is a strategic buy on dips or scale in position. The Phase 3 metrics, wide moat, and DCF baseline confirm business quality is exceptional. I recommend dollar cost averaging, take a 25% starter position near current levels, and add on pullbacks toward the $115 to $120 support zone. Do not chase it on spikes. For existing holders, hold. The fundamentals haven't deteriorated. Trim only if PLTR exceeds 5 to 7% of your total portfolio, or if you need to rebalance asset allocation. Let the compounding engine work. For short-term traders or value-first investors, do nothing or wait. The 90 times forward PE and wide analyst dispersion mean you'll face 15 to 20% swings on earnings reports or rate shifts. Wait for a clearer technical entry or rotate into AI-adjacent plays with lower multiples. And crucially, set a thesis breakers. If quarterly revenue growth consistently drops below 30% or operating margins contract for 2 straight quarters, the Phase 3 thesis breaks. That's your signal to reassess or exit.
That's incredibly clear and actionable. So to wrap it up for our viewers, Palantir is a fundamentally elite Phase 3 growth company with a widening moat driven by AIP and enterprise AI adoption. The DCF points to fair value around $149, while analysts project $158 to $184 on sustained execution. It's not a cheap stock, but But it's not overvalued if the growth trajectory holds. Long-term investors can accumulate strategically, existing holders should hold with discipline, and short-term traders should respect the volatility.
Exactly. The data confirms the business quality. The valuation premium is justified by the growth, but it demands patience and position sizing. Never let a multiple dictate your timeline. Let the thesis and your risk profile do that.
Fantastic insights. If you found this breakdown helpful, hit that like button, subscribe to Build Wealth Now News, and drop your questions about PLTR or any other ticker in the comments. We read every single one. Until then, trade smart, manage risk, and keep building wealth. I'm Billy Bob. Sarah's been our analyst, and we'll see you on the next one. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.